Hello and welcome to the Saturday Summary for January 25th, 2014, your weekly summary of market and economic news for annuity and life insurance professionals. I'm Jonathan Illing for The Biz. Now be sure and click on the subscribe button to have this summary delivered to your inbox and receive our special offers. Let's start with a quick review of what's happened this week. There's a lot to talk about. As you can see on the headline here, reality set in this week after the market bubble inflated so broadly in 2013. All broad market indexes are back in negative territory for 2014. We're also seeing steady declines in the rolling one-year point-to-point results as well. Now, after a flat start to 2015 and following the MLK holiday weekend, reality began to catch up with the equity markets on Thursday and Friday. Thursday saw the S&P index drop by nearly a point, and Friday added fuel to the fire with the S&P 500 losing another 2.09%. This is for a weekly loss of 2.63% on the S&P 500. The other broad U.S. and global indexes fared no better, with the Dow Jones Industrial Average ending the week down 3.51%, the NASDAQ Composite with a 1.65% weekly loss, and the seemingly unstoppable Russell 2000 Small Cap Index posting a weekly loss of 2.08%. Now, this is not yet a major correction by any means, but it may be the start of an expected reversal in global stock prices. Most market watchers consider a major correction to be a decline of at least 10%, so by that measure, we're only starting down that path. Nevertheless, there is little on the horizon at present to reverse what is becoming increasingly bullish sentiment on the part of professional investors, save another intervention from the Federal Reserve. Now, the bubble may be getting ready to pop, and looking at this, we know what has happened in the past when these market bubbles have collapsed. By the way, this is the sort of support that our producer clients receive. Next up, speaking of the Federal Reserve, next week the Federal Open Market Committee meets. Now, this will be Ben Bernanke's last meeting, and Janet Yellen will take over the helm on February 1st. Now, given the market results so far in 2014, some pundits are speculating that the Fed may well back off on its decision to reduce QE stimulus. This will be a telling moment for the Fed. They've maintained publicly all along that the trillions of dollars of stimulus indirectly injected into the banks and investment banks has not been intended to directly support the stock market, but rather to help Main Street. Now, this week, if they back off, or really next week, if they back off their stated intent to reduce stimulus, it will be difficult for them to maintain that charade, particularly since interest rates are already dropping due to natural safe haven demand, and the unemployment rate is still decreasing. Next week will be a most interesting, and it could be a wild ride on the street. Now, they don't call it a roller coaster for nothing. Now, unfortunately, as the equity markets are flat or declining, demand for the safety of U.S. government bonds is increasing. Thus, the yield on the benchmark U.S. 10-year Treasury Note has continued to decline in 2014. This is not good for our retired and soon-to-be retired clients who are risk-averse. And if this decline accelerates, it's going to make it increasingly difficult for our insurance carriers to provide the level of index caps and rates that we are now enjoying. If you are waiting to move to safety, you may want to take advantage of the rates on indexed annuities and life insurance contracts that are available right now. Now, this is a good time to introduce our new readers and viewers to the CNN Fear and Greed Indexes. I really like this thing. It's updated every day. The CNN Fear and Greed Index combines 7 market metrics to produce a really simple visual representation of market sentiment. As we can see here on the Fear and Greed indicator, it's moved to fear, and it's a very rapid decline from its greed rating of just 1 week ago. There's a hyperlink to the Fear and Greed Index in the written version of this week's summary, so be sure to subscribe and get the written version. Moving on, as always, we like to share some quotes from the financial press that you can share with your clients. First up, once again, we turn to Graham Summers of Phoenix Capital Research, who on January 21st wrote, "Among the financial institutions that are dumping stocks include the Apollo Group, Blackstone Group, and Fortress Investment Groups. These groups are not only selling themselves, but they've been urging their high net worth clients to sell as well." What's his point? When the rich are taking their chips off the table, perhaps the average investor should be doing so as well. Our next quote comes from McNeil Curry at Bank of America, who wrote on Friday that anxiety across the markets has reached a near-term extreme. The trends of the past few days, weeks, are set to correct, but not turn. The break of 1809, speaking of the S&P 500, has invalidated our bullish view, but we are not bearish, just neutral. Well, in my view, that's double talk. Only the Swiss are neutral. They're just afraid to say they're turning bearish after hawking the market for so long. Coming up next, a quick overview of this week's articles from the financial press. First up is titled, How about a 50% crash? This article was published this week in MarketWatch, and it's written by John Nyardi. In fact, it was published on Friday before the big downturn. His point is that stock prices have climbed way above normal valuations based upon what we call price-to-earning ratios. He goes on to say that when we apply this to the widely accepted metric called CAPE, or cyclically adjusted price-to-earning ratios. This was developed by Nobel Prize winner Robert Shiller. Nyardi is pointing out that the S&P would have to drop about 50% to get to the historical CAPE valuation. He goes on to say that even a less extreme correction where PE ratios reverted to just their 2013 levels, we would see the S&P drop by about 35%. Nyardi states, in considering what could trigger such an event, it is important to keep in mind that the current level of stock price is apparently being driven by investor sentiment rather than fundamentals. No kidding, John. He then concludes with, at this point, it's quite possible that the high water mark has been reached and the tide may be turning. Next up is an article titled, A Top is Forming. Is it the top? This was published at Zero Hedge. This article discusses the volatility index, or specifically the pattern of the volatility index, also typically called the VIX. And in this article, he states, put simply, the formation of the VIX today is forecasting that we will see a move in the markets on par with the 2010 market top flash crash or the 2011 debt ceiling crisis. Now, the S&P 500 fell 16% from its peak to trough during both of those instances. By the way, on Friday, yesterday, the VIX increased over 28%, a huge one-day jump. Now, folks, as we see these market experts issuing these warnings, does it not make sense to take at least some of your retirement savings to safe vehicles that will protect you from the coming economic storm? So, next up, the summary is going to bring you a few other articles. I'll go over them very quickly. Here we go, 3 risks that could crash the market. It's great talking about what could potentially happen. Next article is titled, What Will Trigger the Next Correction? You shouldn't expect to see it coming. Basically saying, rarely do we see these things in advance, or at least easily. Finally, a couple of articles on troubles in the emerging market sectors. One of the issues that's really caused a problem this week in the markets and starting to cause this sell-off, at least ostensibly. This particular article is about some problems in Argentina and currency problems in the emerging market sector. And then actually a pretty important article. This is on an article about more trouble in China. Titled, Is the China Bank Run Beginning? Farmers Co-op Unable to Pay Depositors. Now, this article talks about the increasing liquidity and debt crisis developing in China and the apparent shuttering of some local banks, leaving depositors unable to get their money. Now, you may think this is insignificant. Believe me, this matters to your global economy. So, that's your Saturday summary for Saturday, January 25th, 2014. Now remember, to have the written Saturday summary delivered directly to your inbox and receive a link to this video and our special offers, be sure you click on the subscribe button next to this video. That's it for this week. Thank you for joining us, and we'll see you next Saturday.